The air is thick with anticipation. Earlier this week, almost 85% of active market participants believed the Fed would cut rates in December. Stimulus-addicted Wall Street scaled a new lifetime high on hypes of dual stimulus, that is, President-elect Trump's fiscal stimulus and the Fed's monetary stimulus. Wall Street holds its breath as the financial world stands on the precipice of a crucial decision. Will the Fed cut rates in December, or will they maintain the status quo? Almost 65% of market participants now believe the Fed will cut rates in December. Fed officials are now talking overtime to bring down the market-implied probability of a December rate cut to almost nil before the blackout period starts after first week of December. It's the question on everyone's mind, and the answer has the potential to send shockwaves through the global economy. Investors, analysts, and everyday citizens alike are all waiting to see what the Federal Reserve will decide. Fed may be now preparing the market for a pause in December. Usually the Fed never acts without preparing the market well in advance. Current economic data paints a mixed picture, leaving analysts divided on the Fed's next move. Some argue that the economy is strong enough to withstand higher rates, while others believe a cut is necessary to sustain growth. Fed cut interest rates by 50 bps in September, followed by a back-to-back 25 bps cut in November, as if the US economy has fallen in the grip of another financial crisis after COVID. Such panic rate cut actions by the world's most influential central bank Fed surprised many analysts, as such a move is usually seen during crisis times. Some indicators, like robust consumer spending, suggest a healthy economy. Shoppers are out in force, credit cards are being swiped, and retail sales are up. Fed holds rates for 13 months at 5.50% from July 23 to August 24, and was scheduled to start cutting rates every alternate meeting from September 24, with a normal rate cut of 25 bps every alternate quarterly meeting till 2027 for a cumulative rate cut of 250 bps, and terminal longer-term repo rate at around 3.00%. But the Fed suddenly began to panic in September after August job data showed 3 months of the rolling average of the US unemployment rate going above the orange line of 4.0%. Others, such as slowing manufacturing growth, hint at trouble brewing beneath the surface. Factories are not as busy as they once were, and production lines are moving slower. Adding fuel to the fire are the swirling uncertainties of the global trade landscape. International trade tensions have created a volatile environment, making it difficult for businesses to plan for the future. President Trump's trade policies, while aimed at protecting American interests, have injected a dose of volatility into the markets. His aggressive stance on tariffs and trade agreements has left many wondering what the future holds. The ongoing trade war with China in particular has businesses and investors on edge. The back-and-forth tariffs have disrupted supply chains and increased costs for companies on both sides of the Pacific. This uncertainty makes it difficult for the Fed to accurately gauge the economy's trajectory and make informed decisions about interest rates. The data is conflicting, and the stakes are incredibly high. The Fed maintains the unemployment red line at 4.5% and the green line at 3.5%. Fed cuts 50 bps instead of the normal 25 bps in September. Subsequently, the Fed was accused of being politically motivated to help the Biden-Harris admin just ahead of the November election by opting for jumbo rate cuts and inflating Wall Street and public confidence. In the September's 24 FOMC meeting, the Fed has access to core CPI and employment situation data till August 24. The 3-month rolling average unemployment rate in August was 4.2%, and core CPI inflation was 3.2%. The Fed needs to bring down core CPI to at least 2.3% levels and core PCE inflation to around 1.5% for its 2.0% average CPI plus PCE core inflation target in a sustainable manner. Ideally, looking at the data, the Fed should have started the current rate cut cycle from the June quarter end, when the 3-month rolling average of the unemployment rate was 3.9% and core CPI 3.6%. Fed should cut by regular 25 bps each quarter end, that is every alternate meeting from June 24 rather than a panic cut of 50 bps in September 24, followed by another 25 bps in November 24. Fed maintains that big revisions in employment data often create policy flip-flops and raise questions about Fed credibility. Now the question is whether the Fed will cut another 25 bps in December 24 for a cumulative cut of 100 bps in 2024 to stay ahead of the curve, followed by another 100 bps cumulative cuts in both 2025 to 26 for a longer-term terminal repo rate plus 3.0%. Fed needs to dial back restrictive rate gradually to bring down average core inflation back to just below 2.0%. Fed needs to cut rates at a predictable quarterly pace of 25 bps, keeping the unemployment rate at least at around 4.0% longer-term sustainable levels, and then to 3.5% inspirational levels by 2026 to 2027. Thus, Fed is now maintaining that risks on both sides of its dual mandate are in balance as it has to bring down average core inflation by at least another 100 bps and the unemployment rate by 50 bps by 2026 to 27. Fed is also in QT mode, which is financial tightening opposite to rate cuts. Fed is now cutting rates and also reducing its balance sheets in a calibrated manner to ensure financial or money market stability and not to repeat the late 2019 repo crisis during Trump 1.0. In late 2019, the Fed launched rate cuts and mini QE even before the COVID crisis. Fed is now increasing the QT pace to some extent to close the same by H1 CY25, while cutting rates for every alternate meeting from 2025. At present, despite cutting rates by 75 bps since September 24 and anticipated another 25 bps in December 24, the US 10-Y bond yield surged from around 3.60% in September 24 to almost 4.50%. This is because the Fed is doing QT actively, and Trump 2.0 may increase US public debt by more than the current trend rate. All these mean a potentially higher supply of US bonds. Thus, bond prices are going lower and inversely proportional bond yields going higher. Also, Fed is ensuring that 10-Y real bond yield does not go substantially above 1% from average core CPI inflation, which is now around 3.5%. Thus, Fed may not allow US 10-Y bond yields substantially above 4.50% for the time being. Similarly, the Fed may not allow US 10-Y bond yield meaningfully below average core CPI inflation to ensure no negative real bond yield. The Fed is now ensuring a moderate real positive bond yield of around 1.0% to bring down core inflation to around 2.0% targets from the current plus 3.0%, keeping the unemployment rate stable around 4.0% or even below that towards 3.5% by 2026 to 27. President Trump has been a vocal critic of the Fed's monetary policy, repeatedly calling for lower interest rates to boost the economy. His tweets and public statements often put the Fed in the spotlight. Fed has to ensure a soft landing while bringing down inflation to 2.0% price stability targets without causing a surge in headline unemployment above 4.5%. The Fed maintains that it operates independently of political influence, basing its decisions solely on economic data and its mandate to maintain price stability and full employment. This independence is crucial for maintaining credibility and effectiveness. However, the timing of the November cut, just weeks before a presidential election year, raised eyebrows. The proximity to the election added a layer of complexity to the Fed's actions. The Fed's actions, regardless of intention, inevitably become entangled in the political arena. Every move is scrutinized and interpretations vary widely depending on political perspectives. The central bank walks a tightrope, striving to maintain its independence while navigating the pressures of political scrutiny. Balancing these factors is a delicate task, requiring careful consideration and a steadfast commitment to its principles. As US core disinflation almost stalled in the last few months, the Fed is now focusing on both core inflation and employment trajectory, rather than too much emphasis on employment as we've seen in the last few months. The last mile of disinflation is always hard, and there is a need for patience. Fed also gives priority to the price stability mandate, which is primarily to ensure sustainable maximum employment. To understand the Fed's dilemma, we need to delve into its dual mandate. This mandate is a cornerstone of the Federal Reserve's mission and has profound implications for the U.S. economy. The Federal Reserve Act tasks the central bank with achieving two primary goals: price stability and maximum employment. These goals are not just abstract concepts, they directly impact the lives of millions of Americans. Price stability is fundamental to ensure sustainable, inclusive economic growth and maximum employment. Otherwise, there may be K-shaped economic growth and prosperity, which will create more inequality. Thus, the maximum employment mandate may be secondary to the Fed, while the price stability remains primary. Sometimes the goals of price stability and maximum employment are in sync. This is the ideal scenario where the economy grows steadily and both inflation and unemployment rates remain low. The US Congress has not provided any official employment target as maximum, unlike the price stability target of core or total inflation at 2.0%. Generally, the Fed and also US Congress maintain that under the current economic scenario, the maximum employment rate is 96.5%, which is minimum unemployment at around 3.5%. But the Fed also maintains that a 4.0% average unemployment rate is sustainable for longer term. Fed also sees the 4.5% average unemployment rate as a red line. Before the November US election, the Fed was under huge pressure from the Democrat-savvy influential market participants and also US Congress, especially from Democrat lawmakers after the unemployment rate surged from around 3.5% in 2023 on an average to above 4.0% by late 2024. As US core inflation almost stalled in Q3, CY24 at around 3.0% on average, while the unemployment rate remains stable at around 4.0%, along with resilient real core GDP growths around 2.8% on average. The Fed may pause in December '24 to assess more data and implications of Trump's anti-immigration policies on US inflation and employment. As per Taylor's modified rule, the Fed should cut the repo rate from the present 4.75% to 4.00% by December’25. Thus, Fed may project only 3 quarterly rate cuts in 2025, accumulating 75 BPs in its December '24 dot plots. But the Fed may also cut 4 times, accumulating 100 BPS in 2025, depending on actual data, and be ahead of the curve, avoiding a hard landing. There's no magic formula, and the Fed must constantly assess the economic landscape and adjust its policies accordingly. This involves analyzing a vast array of data, from employment figures to consumer spending patterns. The projected Fed rate cut of 25 BPs in December, the 24th of May, not be assured, as US core disinflation may have stalled in Q4 CY24 too, while average unemployment remains stable around 4.0%. Fed may also give a pause in December even after favorable data for any cuts, as the Fed may also want to see Trump 2.0 policies, especially immigration and threatened deportations, which may again tighten the US labor market and boost inflation. Thus, Fed may not cut in December '24 and may resume cutting rates from March '25 and may continue to cut every alternate meeting in 2025 to '26 and H1 CY27 for a longer-term terminal repo rate of around 0%. This will be against the Fed's projected core inflation of around 2.0% for a real repo rate of 1.0%. Thus, Fed may cut a cumulative 75 BPS instead of 100 BPs in 2025, depending on actual inflation, employment, and economic activity data and Trump policies. The dual mandate, while seemingly straightforward, presents a constant puzzle for the Fed, requiring a deft touch and a keen understanding of the intricate workings of the economy. Balancing price stability and maximum employment is a dynamic and ongoing process, one that demands vigilance, flexibility, and a deep commitment to the well-being of the economy and the people it serves. Market impact. On Friday, Wall Street stumbled from a post-election lifetime high area on fading hopes of a Fed rate cut in December. Fed's Chair Powell and also other Fed policymakers virtually poured cold water on underlying market expectations of a rate cut in December. The implied probability of a December rate cut tumbled from around 83% before Powell's Thursday speech to around 65% Friday. Almost all prominent Fed policymakers are now providing media bites over time to talk down the implied probability of a December rate cut at least below 50% and to almost nil by first week of December before the official Fed blackout period begins. The market will now focus on the November US NFP job report to be released on the 6th of December, Friday. November core inflation report will come in second week of December during the Fed blackout period. This week, gold also stumbled on hypes of an imminent Gaza and Ukraine war ceasefire under Trump. Also hotter than expected US retail sales and core CPI and PPI data dragged. Weekly technical trading levels, Dow Jones 30, Nasdaq 100, S&P 500, and gold looking ahead, whatever may be the fundamental narrative. Technically, Dow Future now has to sustain over 44800 for any further rally to 45000, 46000 in the coming days, otherwise sustaining below 44750 and 44650. Dow Future may again fall to 42700 and 41600 in the coming days. Similarly, Nasdaq 100 Future has to sustain over 21500 for a further rally to 21700, 22500 and even 23000 levels in the coming days. Otherwise, sustaining below 21450, 21350, it may again fall to 20300 and 19700 in the coming days. Technically, S&P 500 now has to sustain over 6,100 for any further rally to 6,200. 6,500 in the coming days, otherwise sustaining below 6,075, 6,050 may again fall to 5,850. 5,675 in the coming days. Also, technically, gold has to sustain over 2575 to 2590 for a recovery to 2635 to 2700 and a further 2795 in the coming days. Otherwise sustaining below 2575, gold may further fall to 2540 to 2500 and 2460 in the coming days, depending upon Fed rate cuts and Gaza-Ukraine war trajectory. Bottom line, as US core disinflation almost stalled in H2 CY24, while the unemployment rate remains stable, Fed may be on hold till January the size 25 to assess the implication of Trump's unpredictable bellicose policies on inflation and employment. Thanks for your valuable time in watching this video. We will shortly come back with another video.